Posey.
Thank you, Mr. Chairman. Thank you for being here today, Mr. Secretary. In your testimony, you indicate that your objective is a healthier and more stable housing finance system with a broader goal of helping our economy recover. A part of stabilizing our economy is to ensure there's adequate capital in our financial institutions so that money is available for lending for housing, construction, and commercial purposes. You've indicated it's one of your goals, and I assume it's part of the Fed's goal for QE2. Given that goal, I want to call your attention to a recent proposed regulation from the Internal Revenue Service that could have a devastating effect on the capital in U.S. financial institutions. This rule proposed by the IRS could lead to several $100 billion leaving the United States and fleeing to low-tax jurisdictions. It's my understanding that for the past 90 years, our national policy has been to encourage foreigners to put their money in our banks. That money goes to work in the United States economy in exchange for those individuals to earn some interest, and they have the assurance that their money is safe and sound. They also have the assurance that corrupt governments don't have access to that information. I think that's a win-win situation, and you're shaking your head yes. I think you do too. The proposed IRS rule would force banks to hand over interest payment information to the IRS. There would still be no tax on the interest earned, but the IRS would in turn have this information to turn over to a foreigner's home country. This was a bad idea when it was first proposed in 2001, and wisely the administration and Congress rejected it. It was a bad idea then, and I think it's a bad idea now. And I look forward to working with you so that we can maybe do that again this time around. The flight of between $200 and $400 billion from U.S. banks, as apparently would happen if this regulation were put into place, would be devastating to our economy, I think. Furthermore, it would raise safety and soundness issues for our bankers and have significant deposits from non-residents affect those. Do you agree that this is a bad idea and that it's come at a bad time?
Congressman, I'm not completely sure I know which draft regulation you're referring to. I think I do, and if I'm right, I don't think it has the risks that you're suggesting, but I'd be happy to spend some time and talk to you about it and see if we can figure out a way to address your concerns.
I would greatly appreciate that, because I think we're going to need your support here. Again, do you think the housing market has bottomed out yet?
It's very hard to know. You know, we have unemployment between 9 and 10%, and although the economy is growing, and though you've had a big adjustment in house prices, housing is much more affordable now. I think by any judgment, you still have a lot of damage for the market to absorb over time. And that's going to take a fair amount more time.
Yeah, I think we all know that. Just wondered about your personal opinion, yes or no, if you thought it's bottomed out. And I won't go in there.
I'm a very careful person.
I won't be insensitive. Yeah. I apologize for seeming insensitive sometime and being impatient when the people I represent have been ripped off for billions of dollars. People have died over this issue, over this economy. You know, I mean, it's really serious outside the Beltway to real live people. I'm not sure, just as a comment I want to make, that a larger down payment for FHA is going to help anything. I know for over 30 years, most people bought their first homes with 3% FHA down payments, and they paid them back. There's a lot of zero down payment VA loans paid back without problems. You know, we never had a problem until Congress got involved and invoked its will on Fannie Mae and Freddie Mac under the impossible dream that everybody should have a home if they wanted it, whether or not they had a job, whether or not they had income, whether or not it was worth the loan amount. I think if we just get people back to doing their jobs, the 3% down payment is going to work out just fine for this country. And you and I talked before about regulators who were taking performing loans in classifying them as non-performing loans because in their esteemed opinions, they shouldn't have been performing loans. The standard to determine a performing loan historically has been whether or not the loan is performing. Can you give us any kind of help on the ground back in our districts to take this arbitrary and capricious treatment of or to make the arbitrary and capricious treatment stop by some of these out-of-control bank regulators who are apparently overreacting for their failures to do their job in the first place?
Well, if you gave me the authority to do that, I might be able to do it, but that's their authority. And what I can do is I share your concern, and I know that if you've talked to Chairman Bernanke and Chairman Baer and the head of the OCC, that they are worried about this problem too, and they are working to try to make sure their examiners bring a careful and balanced approach to those judgments, and they don't overdo it after perhaps being a little bit accommodating in the boom. And I think I agree with that concern, and I've passed on those concerns to them every time I hear them, and as I'm sure you have. And they're working on it.
Thank you, Mr. Posey. Mr. Miller.
Thank you, Mr. Chairman. Mr. Secretary,